Wall Street finds itself at a fascinating crossroads, balancing a renewed wave of optimism with a current of caution that continues to shape investor behavior. After a brief pause in the market's recent rally, futures suggest that U.S. stocks are preparing to open slightly higher, with the S&P 500 and Nasdaq showing modest gains. While this points to resilience in equities, there's no mistaking the hesitancy lurking beneath the surface, particularly as Federal Reserve Chair Jerome Powell's warning that equities may be fairly highly valued echoes through the financial community. The most intriguing story this week has been the rally in small-cap stocks. The Russell 2000 index notched a fresh record, crossing 2,467 for the first time in 4 years. For many investors, this surge is a welcome reminder that momentum is not just confined to the tech-heavy giants that have dominated headlines for the past several years. Analysts suggest that small-cap stocks, often more sensitive to economic shifts and policy moves, may be benefiting from renewed confidence in a friendlier monetary environment. The Federal Reserve's recent rate cut of 25 basis points is being read as a gift for the broader market, easing borrowing conditions and giving smaller, more capital-hungry companies a chance to shine. Yet this optimism has not erased the undercurrents of caution. Tech stocks, the very sector that has powered much of the market's growth in the past decade, have been under pressure. Profit-taking, combined with heightened concerns over valuations, has weighed on some of the market's most celebrated names. Even as the artificial intelligence boom continues to attract long-term bullishness, short-term jitters are keeping investors from charging forward without pause. This tension reflects a broader truth about today's market climate. Investors are torn between the excitement of potential growth and the sobering reality of stretched valuations. Adding to the complexity is the fragile state of the U.S. economy under the strain of tariffs. Reports indicate that industrial inventories are rising while demand cools, signaling possible cracks in economic momentum. The services sector has slipped to a 3-month low, and manufacturing, too, shows signs of deceleration. While the Fed's rate cut was intended to soften the impact of these headwinds, the underlying structural pressures created by ongoing trade disputes remain unresolved. Businesses continue to absorb the cost of tariffs, and many worry that any escalation could shake the delicate balance that has kept markets afloat. For now, traders seem willing to look past these risks, encouraged by the Fed's actions and the belief that monetary policy can continue to act as a cushion. The image of a market perched on a tightrope feels apt. On one side, a backdrop of low rates, bullish momentum in small caps, and the enduring promise of technology-driven growth. On the other, the weight of trade tensions, inflationary questions, and Powell's reminder that the market may already be running hot. It is this interplay of optimism and unease that gives the current moment its energy. Unlike in previous rallies that were fueled by a single dominant force, such as big tech or pandemic recovery, today's upswing is more diffuse, pulling from diverse pockets of strength. Small caps are enjoying their time in the spotlight, commodities like gold are attracting renewed interest, and certain industrial names are showing resilience despite tariffs. This breadth offers encouragement to those who believe the bull market has more room to run, though it also complicates the picture for anyone hoping for a straightforward narrative. As Wall Street heads into another week, the central question becomes whether this balance can hold. Can the Fed's rate cuts sustain momentum without inflating new bubbles? Can small caps carry enough weight to counteract weakness in tech? And can the economy navigate the turbulence of tariffs without tipping into a broader slowdown? Each of these uncertainties will determine whether the market's current cautious optimism evolves into a sustained rally or falters under the pressure of unresolved risks. For now, the dance continues, with investors stepping carefully, weighing promise against peril in an environment where every move feels both precarious and full of potential.